Right. So we will resume from clause 7 of Article 3, where we were talking about investment income from a qualifying investor's income from qualifying investment fund. And in clause 7, it has a cross reference with the participation exemption, as we were discussing. If the investor disposes of its ownership interest in a qualifying investment fund, and this Article 23 does not apply, then what happens? The investor's taxable income, Article 3 means participation exemption does not apply. Then the investor's taxable income in the tax period. Acha, before I move forward, let me ask you something. What would be the meaning of this sentence until here? If the investor
If
disposes of
investor
his
disposes.
interest, okay, that's easy to understand. Huh? They is sold off the ownership interest in the qualifying investment fund. And
Mhm.
Article 23 does not apply to such disposal. What is the meaning of that?
Participation exemption does not apply for this such disposal.
Yes, participation exemption does not apply. So
Hmm.
this disposal was subject to corporate tax. Then what happens? The investor's taxable income, that's why they use the word taxable income. They did not say exempt income. Article 23 is about participant exemption. An investor's taxable income in the tax period in which the disposal took place shall be adjusted. It shall be adjusted to do what? To exclude undistributed profit that was included in its taxable income in relation to that interest in accordance with clause 5 of this article in that tax period and any previous tax periods. What was clause 5? If you recall, what was clause 5? Without prejudice to clause 1 of the article and unless clause 2 of the article applies, where a qualifying investment fund, with the exception of a real estate investment trust, has any, if you really think about it, na, here it starts from here. If the qualifying investment has immovable property percentage above 10% in its financial year, this was that situation where a larger amount, more than 10% of the portfolio is comprises of immovable property. Immovable property percentage above 10% is fine. The taxable income of the inventor of the investor who is a juridical person shall be adjusted to include only 80% of the immovable property income, prorated immovable property income. 20% will remain out of the tax net, right? That was the clause 5. So let's read what was said here. Initial part we had understood that if it does not apply, it becomes taxable income, and the person disposes of. Then what will happen? In which the disposal took place, in that year in which he disposes of that interest, that his taxable income will be adjusted to exclude
Mhm.
undistributed profits of not only that taxable year but previous taxable years as well, subject to not exceeding the taxable gain arising from such disposal. Subject to not exceeding the taxable gain arising from that disposal. So, uh, uh, let me uh, describe this. Uh, it- if an investor is there and he has ownership interest in a qualifying investment fund, and and there are such ownership interest to which participation exemption does not apply, that is also there. Invested and he has taxable income. So naturally, all the income from this qualifying investment fund becomes taxable income. Investors' taxable income in the tax period in which this disposal took place shall be adjusted to exclude any undistributed profit that was included in the taxable income. So if we had included undistributed profit in the taxable income because it was undistributed, that is why we had taxed it, right? But now the person sold it off, right? So it has been realized in relation to that interest in accordance with clause 5 of this article. That clause 5 said that include 80% of the immovable property income, right? So all of that income will be, it will be exclude undistributed profit income that was included in the taxable income, uh, subject to uh, subject to not exceeding the taxable gain arising from that disposal. What is the meaning of this last part? Can somebody tell me? Okay.
Subject to not exceeding the taxable gain or raising from such disposal. So the profit should not be more than the mentioned amount when their disposal happens.
Okay, Vinay, what about you? Can you,
Subject to not
Hmm.
exceeding the
whatever you have understood, Vinay, just explain that. If not, then we will make sure that you understand.
Not understood.
Not understood? Okay. What about you? Let's repeat what you just said, Rafi. Let's see what you understood.
So the amount should not exceed the profit should not exceed at the time of disposal. Certain amount which is mentioned should not exceed at the time of disposal.
When we dispose it off, and if
Mm-hmm.
there is a taxable gain arising
Gain.
from disposal, that's the upper limit. That's the upper limit.
Uh,
We will exclude the undistributed profit from all this investment, but not all of it, only to that extent to which we had already,
disposal value.
huh? Yeah,
Disposal value.
we had in the disposal value we did some gain, right?
Mm-hmm.
There is a market value, and when we sold off, it
Yeah.
was, we
Yeah.
realized a gain. There was a, that gain will be limited to subject to not exceeding the taxable gain arising from such disposal. We cannot remove the undistributed accumulated undistributed profits from our taxable income. We can only exclude to the extent of the gain that arises from such disposal. They said that
So,
we can
so the gains
read
that is
this.
arrived from the disposal.
Yes. So let's say shall be adjusted to exclude undistributed profit that was included in the taxable income. You see this point?
Mm-hmm.
What are we going to exclude from the taxable income? Whatever amount of gain that was, whatever amount of gain that we had already booked over the years, not only in that tax period but previous tax period as well, right? Whatever gain we had booked in there, it should, we cannot, we will be restricted to exclude the profits maximum equal to the taxable gain on disposal. That's it. In easier words, the maximum amount that can be removed from our taxable income will be equal to whatever gains we reaped from the disposal. If our investment, let's say, was it reaped, let's say, 1000 dirhams, and in that, this is the disposal value. In that we had 100 dirham of gain. Why? Because these securities are marked to market, right? Always at the end of the year or on a periodic basis, right? So if the in our books, if the carrying value was less than 1000 dirhams, then we will record a gain, right? Let's say 100 dirhams gain. This is the maximum amount we can exclude. This is what is being said in easier words. Make sense?
Yes.
Yes.
Okay. For any immovable property located in the state, if real estate is located in UAE, that qualifies for a depreciation deduction under the decision issued by the minister governing depreciation adjustment for investment properties for the purpose of the corporate tax law. Uh, there is a decision that was issued under corporate tax which said, there is a depreciation adjustment for even for investment properties that are on amortized cost model. So if there is a depreciation adjustment, an election pursuant to the said decision to apply depreciation reduction to an investment property held at fair value basis is deemed to have been made by a qualifying investment fund. So, okay, let me ask you something about investment property. Any idea how the accounting for investment property is done?
REIT, right? You're talking about.
No, no, it's a very simple
No.
question. No REITs, no investment. I'm simply talking about an accounting question. There is IAS 40 investment properties. So it gives two different models of recording investment property. If you don't know, let me tell you.
Realized?
Sorry?
Is it something related to realize the gains or something on the properties?
Yes.
Uh,
But
uh,
about gains, not realized or unrealized. There are two models for investment property. One is called the fair value model. The other one is amortized cost model.
Cost model.
Hmm. Cost model. Fair value model is the predominant model around the world. In that model, investment property is revalued at the end of every financial year, and they are basically mark to market. And if there are any gains or losses because of such revaluation, their treatment is that gain or loss is routed through where? Other comprehensive income or the income
OCI.
statement?
OCI. Other comprehensive income.
No, it is routed through income statement. Read the standard, you will know that for investment property, if there are gains, mark to market gains, they are routed through current year's P&L.
Okay.
And they're saying that the decision that they're referring to says that there is a depreciation adjustment that is allowed by the minister, that is to be done by the as recommended. So it's an election pursuant to the said decision to apply depreciation deduction. If taxpayer says no, I want to elect for the depreciation adjustment for investment property, that person can do that. Held at fair value basis is deemed to have been made by the qualifying investment fund. In easier word, a qualifying investment fund can also utilize this facility and they can claim certain amount of depreciation adjustment on the investment property. Does this make sense?
Yes, sir.
okay.
Rafi?
Yeah, okay.
The investor whose income is adjusted pursuant to clause 2 or 5 of this article may adjust its taxable income to include such depreciation adjustment. Clause 5 we saw it was related to investment property, and what was clause 2? Let us quickly have a look at here. This was clause 2. So in all of this we talked about the control and everything. So in any case, the point is that this adjustment can be made. Now, the taxable income of the investor shall be increased by the depreciation amount previously deducted under Article 8, the previous article that we read of this article, in the tax period in which any of the following occurs, whichever is earlier. Now, so what the facility that was given in this clause 8 will be revoked. Basically, it will be reinstated when disposal of the immovable property by the investment fund, if the fund just sells it off, or disposal of the ownership interest in the investment fund by the investor, or the investor says, no, I no longer want to invest, I want to sell. So when he sells, or the investment fund disposes of the property, in either case, what will happen? Whatever deduction or depreciation we had claimed, it will be reinstated, it will be reversed. Clear?
Yes.
Yes.
Okay. Clause 10 says that where the investor in a qualifying investment fund is a non-resident person, it may appoint directly or through the qualifying investment fund or its investment manager a tax agent to act on its behalf. But please remember the words here. It may. May means it's an option, it's not compulsion. It may appoint directly or through a qualifying investment fund uh, uh, or its investment manager a tax agent to act on its behalf in respect of the obligation in accordance with the provisions of the Federal Decree Law number 28 of 2022 referred to above. This, what is this law? Do you know, guys? Have you heard about this law? This is tax procedures law. So, the real role of a tax agent, actually, if you really think about it, it's not investment advisory, which is governed by the Federal Decree Law number 47, the mother law of taxation. Actually, the tax agent is a specialist in this Federal Decree Law number 28, tax procedures law. Okay, so he helps people, taxpayers, etc., whether it is VAT or corporate tax or any other thing. The tax agent helps them navigate through the tax procedures. That's why tax agent is appointed, referred to above. So in short, a qualifying investment fund can appoint a tax agent. It's simple as that, no complications. A prorated immovable property income shall be calculated based on the investor's tax period. And acha, we are talking about the prorated immovable property income. You remember what was the immovable property percentage we talked about? How much amount of immovable property exists as assets in the portfolio, right? And prorated immovable property income will be how much amount of income the fund generated and how much of that was the share of the investor. That's prorated immovable property income shall be calculated, and even that 80% and 20% rule will also come in. That all of that will result in the prorated property income shall be calculated based on the investor's tax period and the period which a profit distribution relates to for a qualifying investment fund that distributes 80% of or more of the immovable property income within 9 months from the end of the financial year. Meaning before filing the return, it has distributed at least 80%. Or the holding period of the ownership interest for a qualifying investment fund that does not distribute such percentage within the aforementioned timeline. There can be a situation that the qualifying investment fund does not distribute this much amount of money. So why was all of this these two different scenarios read? The prorated immovable property income shall be calculated. This is the calculation basically. Shall be calculated based on the tax period in which and the period which a profit distribution relates to. So this whole point is being said for calculating the prorated immovable property income. So it will be related based on certain variables. What is the tax period? With which scenario do they fall in? Like, is it that this 80% distribution model or otherwise? Do not distribute, they didn't distribute. So in that case, that 20% relief will not be given. The entire income will be taxed. You guys remember that? So it's a memory hook for you guys to remember that at the 80% rule, if somebody asks you in simpler words, how will you explain the 80% rule of immovable property, Rafi?
80, I'm sorry, sir, what?
There is an 80% rule in immovable property income. You remember that? We discussed that earlier, right? That
Yeah,
and
I don't.
if a qualifying investment fund has a certain amount of investment property and then the fund is very active and they want to benefit the investors, so what do? Before 9 months, they distribute 80% out of it.
Hmm.
Right? In all around the
Yes.
world, you will find in India also, you'll find this thing in Pakistan also, especially for mutual funds, Mudarba, all those rules, when you read, you will find that this is a common thing. Those funds, those entities that distribute profit, and this interestingly, this 80% rule you will find in India, Pakistan, and other countries as well. Same 80%. Usually sometimes it may differ, it may go increase 90% or whatever, or 100%, but the emphasis is on distribution. What happens when a fund distributes the income? It becomes real. Okay, it becomes real. Tax avoidance is no longer there. The investors who are public, general public, or they are benefactors of the economy. Investors are very kind that they are planning to invest in UAE, right? So how does UAE respond? That we are very happy with you. You guys invested, and we are very happy with this investment fund also, which actually fulfilled our promise to the investors that the grass is all green here. You know, so you guys came and now you've gotten your benefit as well. So we are happy for the overall scenario. That's why we're going to give you a certain gift of exemption, of 20% exemption. So if you get whatever income you have actually received distributed profit, so you will only tax 80% of it. Rest of the 20% will go into relief. Okay. But the other scenario is if you don't do that, then the 20% relief will no longer be available. Entire income will be taxed. That's the overall layman discussion of it. Is this clear, guys?
Yes, sir. Sir, I have a question on this.
Yes, please.
Sir, can you please give an example of this one qualifying investment fund in UAE? Like, what are the, like, do you know
Actually,
any?
okay. So if you, I'll tell you. See, I could give you the debt security example very quickly, like national bonds and all. But
Mm-hmm.
then national bonds is for debt. If you invest money into it, it's not equities investment, it's debt investment actually.
Yes,
But other than that, invest debt is a jilted security, kind of a government-backed security. The returns are guaranteed, and that is why you will find that the level of returns are less, right?
yes,
A certain percentage, 5%, 4%, whatever it is, right? The high risk, high reward scenario happens in equity investments. So you invested in Tesla and boom, the the security hit the sky, certainly, and you got super profits, 200%, 300%, 1000%, etc. Tech entities have even given thousands of percentages, right? Shares. Nvidia is a great example. Anthropic is a great example. Chat GPT company, what's its name? It's a so the you know these investment funds that have been opened in these financial services hubs, they are companies. I can't remember immediately one name or anything, but when you look at it, you'll get a very large list of those companies. You will find, right? Or rights are also there. Very too many rights are there, right? So when you invest in there, what do? They give you a document which evidences your ownership as a member of that particular fund, which is set up by an investment management company. Okay, so you will become a part owner of that fund, like an equity holder, but you will be the owner of the fund directly. Now
okay,
that fund itself is going to own shares in a number of other companies,
Multiple companies.
multiple
Basically,
companies.
it's called
That is
like PMS, portfolio
yes.
fund management.
Yes, exactly. So that this will be called a portfolio. Multiple entities will be there. Sometimes it's a
Yeah, yeah.
managed portfolio, diversified portfolio. Different techniques are applied, hedging concepts are applied, etc., etc. So based on the performance of all the different companies' shares in which that fund has invested, Vinay, that
okay,
will result in an overall portfolio gain or loss. Some of the shares will exhibit losses, some of the shares will exhibit profits, some will exhibit super profits. Some who are dealing in crypto and all that, they might exhibit super losses, but at an overall portfolio level, the investment manager has already done too much of research in it. They have designed feasibilities and actuarial valuations of it, and actuarial studies they have performed, so they know statistically what will be the likely outcome of this fund even a few months from now, or a year from now. So based on those scientific studies, they will develop that portfolio. So they'll know that, okay, on an overall level, even if this goes sideways, this goes upways, this goes downways, we are going to end up reaping 15% or 20% or even a higher percent, or sometimes in certain cases lower percentage as well, out of the investment in equities and securities. And once the overall profitability comes in, it will be a pooled profit, like mutual funds. And then based on how many fund units you hold, mutual fund units you hold, one of the best examples is mutual fund for this investment fund. A mutual fund itself is an investment fund.
It's a kind of a fund which has been created, say, for example, like categories of mutual funds, large, mid, and small. And on each category, there will be a listed stocks in it.
Yeah,
With a,
absolutely, yes. And the interesting part is that even those funds units are listed. Forget about the investee companies, they are already listed. It is one of the primary conditions of such funds. that the securities should be traded on stock exchanges, recognized stock exchanges. But the interesting part is that the fund units themselves are listed on the stock exchanges usually. Sometimes they might not be listed as well, but publicly available. You know about the difference between listed public companies and unlisted public companies, right?
Yeah.
Yeah, so it can happen that some of the public companies may not be listed also. But Vinay, does this answer your question?
Yes, sir.
Okay. So Article 4, conditions to exempt a real estate investment trust from corporate tax. Whenever if you guys want a break, let me know. I know it is difficult. This topic is
Yeah,
probably
it's
one
okay.
of the two most difficult topics in the corporate tax is this investment, qualifying investment conditions. So, but we will be patient. We'll go through it once and for all, because once you have learned at least, even if you know you are able to speak 60-70% on what you have learned today, believe me, people will be impressed. Nobody can easily talk about this topic. So, but you guys, mashallah, I can see that you guys have understood or and discussed and challenged. It is amazing, very good. So learn that and you will be an impressive tax practitioner. You will be talking about this with other people. Anyways, conditions to exempt a real estate investment trust from corporate tax. Now we are coming to a favorite topic. It's a huge market in UAE, right markets, right? Real estate. A real estate investment trust shall meet all of the following conditions in addition to conditions under clause 1 of Article 10. You remember this we discussed earlier as well, Vinay?
Yes, sir.
Article, what was Article 10 again? Investment funds,
Articles.
right? Qualifying investment fund.
Yes. Yes.
Right? And we had read that there are certain conditions that the qualifying investment fund should match so that they can be exempted, right? Some of the off the hook common sense things that come to your mind. When are investment funds, when do the investment funds enjoy exemption? Can you remember? We discussed this.
Mm.
Yeah, common sense answer. Investment fund, na? We talked about mutual fund. When will they enjoy exemption? Kya naam hai? Rafi, would you like to say on this?
Uh, I'm sorry, sir. I didn't get it, the exact question,
My question
firstly.
is, when do investment funds, qualifying investment fund actually enjoy the exemption? When do they become qualifying investment fund? What are the conditions of this exemption? That was addressed in clause 1 of Article 10 in the mother law, the last article of the exemption, qualifying investment fund, the initial part of it. There were certain conditions identified there.
Qualifying investment. Let me try to recollect it. Hmm. If you can pull up the chart, it will be better. Yeah, pull up the.
You remember the biggest thing I had said was regulation.
Regulatory oversight.
Then the second thing I had said was that fund, the interest, the units, mutual funds, etc., should be traded on a recognized
Like a stock exchange, yeah.
stock
It should
exchange,
be publicly available.
publicly available. It should not be tax avoidance, right?
Yeah,
And
yeah.
etc., etc. These are the you these are easy to remember conditions, yeah. Even if you
The
did
one of the
not
major
read,
conditions to remember is it should be publicly available in the
uh,
market.
Vinay, these are so easy
Yes.
to remember that you don't even need to read this article, believe me. If
Mm.
if if you were to develop this article, na, believe
Mm.
me, the immediate things that will come to your mind, what are we talking about? We're talking about investment funds, right? Mutual funds,
Mm.
like that. Why would a government exempt a mutual fund or an investment fund? Something, there has to be some level of good features in it, right?
Mm.
What will be those features? For I mean, you common sense, you will say, even if you ask a layman who's not a professional accountant, he's going to say, yeah, it will have to have a very big public image, right? How will that
Mm.
image come? Through regulation, transparency, right? So I mean, common sense things that I can think of, it will have to be some body will be there that will be controlling it, right? Very strictly controlling this. These are, I'm not even looking at the article right now. I'm talking like a layman. The governance should be there, rules, regulations, common sense language, right? Rule regulation should be there. It should have a great image and it should be very well known. How will it be very well known, bhai? It will have to invest in big companies, right? Then only it will be very well known, right? So and the fund itself, which offers the mutual fund, their units will need to be traded on a recognized stock exchange, right? And because of the
Regulated.
regulation, they will not be doing tax avoidance. These are the common sense answers, Vinay. This corporate tax law, actually, if you really think about it, is all common sense. So even if you don't know the answer to certain question, na, think about common sense that I have read it, it is in my subconscious. I only need to click that and probably it will suddenly come out of my subconscious and I will be able to
Yeah,
answer.
I think two things we can remember is like, for investment, qualifying investment fund, that one of the two major points that we always remember is traded on recognized stock exchange
Yes,
and publicly available.
absolutely. You stole my words. If you remember these two things, and these two things are common sense things, everyone will know this, right? Governance, clarity, transparency, which is one word, regulation. Regulation is one answer. Second is publicly available. You're right. Absolutely right. So these two things we remember, then we don't even need to remember what is the article number, what is the clause number. We don't need to remember. Remember the spirit of the law. Okay. Anyways, coming to the going forward. Yeah. So what are they saying? A real estate investment trust shall meet the following conditions in addition to conditions under clause 1 of the article 10. So thus a real right will not only need to comply with these 2 or 4 conditions that we just read in the mother article, that publicly available, regulated, no tax avoidance, etc., right? And what are the in order to apply for the authority or the exemption, what are the other conditions? First condition, the value of immovable property, excluding land, under the management or ownership of the real estate investment trust and any exempt person specified
Yeah.
under paragraph F, H, I of clause 1 or article 4. Remember 3 categories, F, H and I. Uh, I was the very last one, so it was others. You can remember it like that, right? F, sorry, the second last was investment funds or maybe pension funds, if I remember. Pension fund and this F must be that investment fund. So these were the categories that were identified there. Or maybe it was the subsidiaries, but we'll see about that. Maybe H was subsidiaries, I think, and F was investment fund, I think. Uh, G was not mentioned there, which was pension fund and social security fund. But uh, right. So the immovable product excluding land under the management and ownership of the
This
investment
is for
trust.
a REIT to be qualified, right? The REIT to be
Yeah, yeah,
called
yeah. This
as
is
the
yeah,
quali.
yeah. To
Yeah.
enjoy the
Okay.
exemption. These are the additional conditions for exemption of a REIT.
Hmm.
An exempt uh, what was
Is
or
it
ownership
additional or
of
this is major?
no. This is additional meaning at par with the original conditions. The, there is no major minor. These
I
are
mean to say that the REIT will not be created if the fund is less than 100 million, right?
that will be defined in the REIT law itself. If you have read the
Okay.
REIT law and it says that this is the bare minimum capital that is required, then yes, I don't recall recall reading this law, so I cannot comment whether the minimum capital required to create a REIT is 100 million. Have you read it?
Yeah, the somewhere it's written like on the REIT
Okay, there is
rules.
a
It
law.
says
There
that.
is a law.
Yeah.
There is a law. Yes, you are absolutely right. There is a very detailed law on REITs, and chances are that there will be mention of the bare minimum share capital. And if you have read it and recall it as such, then okay, then I hear you. So, anyways, whatever is written in that law, we will leave that, but we'll go through what is written here. I don't know. Maybe it is less than 100 million. So I don't know about that. So until I read it, but the point is that uh, let me read back again. I'll complete this and then we'll talk about it. Value of the immovable property, excluding land, under the management or ownership of the right, and any exempt person specified under this of the wholly, directly or indirectly owned and controlled by the right exceeds 100 million dirham. So this is the bare minimum amount of the value of of the immovable property, that should be under the control of the REIT or any other exempt person under these clauses of the corporate tax law, which is wholly owned and controlled by the REIT. It should be at least 100 million dirham. That's the value of the immovable property. Memory hook, from a memory hook perspective, two words: value of immovable property should be 100 million. That's it. Okay. Where any of the following is met. Now, one more condition: where any of the following is met, at least 20% or any other percentage as specified by the minister of its shares, of the shares, are floated on a recognized stock exchange. Okay, so that's probably making things a bit easier. Not the entire share capital, but only 20% of the share capital has to be floated on a recognized stock exchange. Remaining can stay unlisted. And the real estate investment trust and its related parties or connected persons do not subscribe to or purchase any of the floated shares. Okay, so interesting point. The 20% shares, 20% or other percentage specified by the minister, they have to be floated on the recognized stock exchange of whom? Of the REIT itself. And the REIT does not purchase its own shares. And the real estate investment trust or related parties or connected persons do not subscribe to or purchase any of the floating shares. No treasury purchases. Okay, how much percentage? 20% should be floated. And this says any of the conditions. This was one condition. What is the other condition? It is directly, wholly owned by two or more institutional investors specified in clause 8 of this article. We're going to reach clause 8, in which there will be discussion on institutional investors. Common sense meaning of institutional investor, can somebody tell me?
Institutional investors are like, fund houses, right? Morgan
Yeah,
Stanley,
exact. Finance houses, big players like BlackRock and
JP Morgan.
here so many sovereign wealth funds are there. So they are institutional investors, right? Uh, Specified in clause the provided that at least two of those institutional investors are not related parties. So very interesting point. First thing is that at least two institutional investors should have invested in the REIT. And the interesting thing is that at least two of them should not be related parties. So, let's say two have invested, both are related parties, then we need two more who are not related parties. It's just an example. The real estate investment trust, including any exempt person, uh, specified under paragraphs FHI of clause 1 of article 4 of the corporate tax law, wholly, directly or indirectly owned and controlled by the real estate investment trust. So, by the real estate investment trust, must have an average value of rental income generating immovable property, must have an average value of rental income generating immovable property, excluding immovable property held solely for capital appreciation, of at least 70%. Wow, that's a very interesting point and a key point for us to remember, of the total value of the assets during the relevant financial year. So, if a layman, if I had to explain this to a layman, how would I go about it? Can you guys answer this?
If you could break it down, it'll be better.
Okay, let's do that. So, first, who owns? Let's stop the who owns. So let's start reading from this point. First, the easier, low-hanging fruit we should pluck, right? It says must have an average value of rental income generated in movable property, excluding the investment property, of at least 70%. So if, let's say they have 100 dirhams of investment property or 100 dirham of real estate, okay? How much of that should be income generating? How much of that should be capital gain generating? Is this easier to answer?
Yeah, 70%.
70% should be what? Income generating, right?
Yes.
Rental income.
Immovable property.
Yeah, and the 30% should be, okay, that can be an investment property of capital appreciation. Fine. Investment property, by the way, don't confuse it. Investment property means both categories. Investment property is held for capital appreciation, and the same investment property can generate rental income as well. Okay. Both things we should remember. However, what happens is that whoever is the REIT or the property manager, they can designate it. They'll say that no, this 30% of this property we have kept for capital appreciation only because we're going to sell it very soon. And 70% we are going to keep for rental income. And for this, naturally, then there will be other, the business segments will be different, right? For that part of the investment property which is kept for rental income generation, chances are that the property developer or manager or REIT will have to appoint a facility management company. They'll have to do the upkeep of that property. The HVAC, air conditioning, temperature, parking, facilities, clearance, cleaning, pest control. So many things will come into play for the rental income matter. So additional responsibility and obligation, and that has to be 70%. So the capital appreciation okay. So that was the easier part of that was one of the parts of the overall provision. Let's read the first part as well, and then we will join them together. The real estate investment trust, including any exempt person specified under the paragraph under the Article 4 of the corporate tax mother law. Two persons have been identified here: real estate investment trust, including any exempt person in the Article 4 of the corporate tax law in particular certain clauses. Who are those two types of people, types of persons? Who wholly, directly or indirectly owned and controlled the real estate investment trust. So it both the investment trust as well as those exempt person who are controlling the investment trust. Those three categories of exempt persons. I, the other category. H, the subsidiaries of certain types of exempt persons. And F, the investment fund. I think the pension fund. We'll see. Actually, we can quickly have a look at it. Article 4. Article 4. Yeah. So what was that? F, H, and I. F is in investment fund. H is the subsidiaries. I is the other persons. Yes. So investment fund, subsidiaries of certain types of exempt person and other person. So, and who are those persons? Who control the investment fund, real estate investment trust. Okay. So these two persons, these two categories of persons should have the a portfolio, and that portfolio comprises of immovable property, and in that portfolio 70% is rental income generating, 30% is capital gain generating. If that condition is met, this is a continuation of this condition for exemption. So he said that in order to apply the authority, following conditions must be met, right? In addition, must meet all of the conditions in addition to the conditions previously provided. So we read all of these conditions, the 100 million condition. Then we said that float 20% of it. Then we said that don't let two institutional investors only don't let there should be at least two institutional investors who are not related parties. Then we came to this part in which we said that okay, real estate investment trust, or if there are certain exempt persons who control or own that real investment estate investment trust are there, they should have and if they own a real estate portfolio, in that portfolio 70% should be rental income generating and 30% should be capital gains generating. And if this scenario exists, it can qualify for exemption. Does this make sense now, Rafi?
Yeah.
It's a weak answer. That means it is not clear. What about you, Vinay?
Yeah, it's too many things.
Yeah. This is a labyrinth. This is a labyrinth, but doesn't matter. See, okay, let me again try to rephrase it in simpler words. What are we reading? We are reading additional conditions that are going to result in the award of exemption to whom? To a real estate investment trust. Until now, it's clear?
Mhm.
Yes.
Okay. Then we read certain conditions, the different conditions they had provided. Previously, many conditions were identified. The 20% should be floated on the stock exchange, no related party institution, there should be more than, there should be at least two institutional investors who are not related parties. Certain other conditions also, we were 100 million condition we read. Those are initial conditions. Now we are on another condition which says that there is a real estate investment trust, but that investment trust has a portfolio which has only 60% rental income generation and 40% is capital held designated for capital appreciation. Is this investment trust going to qualify for exemption?
Of course, yes.
No, it will not. That's the whole point of
Why?
here. 60%. I said 60% rental income.
Okay.
But
It
it should be
has
70%.
It should be
Okay.
70%. Only then it will qualify for exemption. Okay.
Mm.
Now one more complication I'm going
So
to create.
anything less than 70 cannot.
Yeah, anything less than 70% cannot. Okay, so this condition. Now we have apparently qualifying in real estate. Another scenario. Okay, another scenario. We have an apparently qualifying real estate investment trust. It does have 70% rental income generation of the portfolio, and 30% is capped for capital appreciation. The second condition of this paragraph is being met, right? Okay. But that real
Mm-hmm.
estate investment trust is being owned or controlled by certain exempt persons, or for that matter any persons who are other than specified in F, H and I,
Mm-hmm.
meaning they are neither the subsidiaries of certain persons identified there, nor it is another investment fund, nor it is any other fund that is specified by the minister, cabinet decision. It is some other company that is holding that investment trust. Now will they qualify for exemption?
No.
No. Does this make sense, Rafi?
Yeah. Yeah, makes sense.
That's the interpretation of this clause. Now is it clear?
Yeah. Okay, perfect.
Okay. Don't worry, I will not move forward unless you have clear concepts about it. To provide its investors with all information, documents and data necessary for the purposes of calculating their taxable income. Okay, let me read. To provide it. This is a common clause. Remember where you read this clause earlier? To provide all information to investors so that they can calculate their taxable income. It's as simple as that. Where did you read this earlier? Guys, don't forget. Look. In the initial part, when we were starting off, I think somewhere over here we read in the initial part that they have to make available, or maybe it was in the definitions that they should make available for investors all information so that they can, yeah, here, this was that. This is conditions for qualifying investment fund exemption. Remember this? Exact same wordings. Okay. This is common
Okay.
in qualifying investment fund as well as REITs.
Mm-hmm.
Where was it? Where were we? Yeah, here we were. To provide investors. Okay. I'm going to okay, not much of it is remaining. The difficult part is about to be over, inshallah. Okay, let's continue until okay. Now I think you guys are getting a hang of it. It's better. Where was it? Yeah. Okay, clause 1, 8, 10 and 11 of article 3 of this decision shall apply to real estate investment trust that is exempt from corporate tax as a qualifying investment fund. Which article are we studying? Article 3, right? Is it Article 3? No, this is Article 4. So, previous article, Article 3, there were certain clauses. Clause 1, 8, 10 and 11 were there. Those clauses will apply ipso facto. So let me read the 1, 8, let us revise the 1, 8, 10 and 11 of Article 3. What was Article 3, by the way? Article 3, if I recall correctly, was investors' income, taxable income. Investors' income from qualifying investment fund, right? What different clauses were there? Article 3, 8. Okay, 3, what was 3? Clause 2 of this article shall not apply to the first 2 financial years of establishment of the collection, provided that there is sufficient evidence to demonstrate that the intention by the fund not to exceed the thresholds under paragraph A or B of the clause 2 of this article. There were certain thresholds that were identified in clause 2. This is clause 2 of this article, and it contained thresholds. Remember, 30% threshold and 50% threshold. That if there are less than 10 investors, if the investors control the fund, then it will not qualify for exemption. And we talked about large associations or political bodies, right, where there are people increase, too many people are there, then the 30% will not matter. Then the threshold increases to 50%. So if an investment fund declares that, look, we are not going to take on too many investors, we're going to remain within the less than 10 threshold, then this fund and says we until 2 years we are going to shall apply the first 2 years, and even not beyond the next year, evidence to demonstrate the intention of the fund not to exceed the threshold, then from the third year, then this exemption will continue to apply. That was the clause 3. What other clause was mentioned here?
8.
8, then 10, then 11. Okay, so let us quickly read clause 8. What where is the threshold? Oh, Article 3. Where is Article 3? Come on. Oh, yeah, Article 3. Clause 8. In this is Article 3, right? This is Article 3, which was for investors' income. We just read the, uh, we were in clause 3. It sent us back to clause uh, 2 of this article, yeah, 30%, 50% rule. And now it is sending, now we have to read the clause 8. What is the clause 8? Yeah, this was about investment immovable property. For the immovable property located in the state that qualifies for depreciation deduction. Yeah, do you recall a little bit about the depreciation deduction? We talked about investment property, and we said that there is a decision that allows depreciation adjustment, and it is an electable decision. Why would somebody want to claim depreciation? Because it will reduce the tax, right? And we also read another thing related to it, that it will be reversed when the investment property is disposed or the owner disposes of their ownership interest. That was the depreciation adjustment. So what they are saying is that the same clause, same treatments will apply to real estate investment fund also. Where was this original clause? This was for qualifying investment fund. Same things, same treatment will apply to real estate investment trust as well. Same thing what you have already read. Then clause 10 and 11 were there. What was 10 and what was 11? 10 was where the investor is a non-resident person. It may appoint directly. It was an easier one, very easy. Tax agent, appointment of tax agent. And what was clause 11? The prorated immovable property shall be how do we calculate the prorated immovable property income? It was given earlier on. We saw that we have to know about what amount of tax period is there. Did the fund distribute 80% of its profits or not, right? These were the things. So so calculation of the prorated immovable property will happen like that. And if all that happens, then the decision will be taken whether to give that 20% relief on the immovable property income or not. Tax only 80% of the immovable property income or tax full property income. So these were the clause 3, 8, 10 and 11 that have been referred in uh, clause 2. Is it still digestible, guys? Are you guys
Yes,
with me?
sir.
Yeah, proceed.
Vinay, okay?
Yeah.
Yes, sir.
Okay, very good. So now we are going to clause 3 of this topic of the real estate investment trust. What are we reading, by the way? Conditions to exempt the rights. Okay, so clause 3 we are on. You see how many clauses have been put on real estate investment trust? So why are they doing this? Why so many clauses, so many conditions? How many conditions in total? If you look at it, these are 8 conditions. We are on the next one. They have put so many conditions on it to keep it uh, in favor of the public, to make it stringent and regulated. And if they meet these conditions, that means there is no tax avoidance that is happening, and more importantly public benefit is being secured, though 80% distribution and all that. Okay, clause 3, without prejudice to clause 1 of article 3 of this decision. Now we have studied it so many times that I think if you are careful, you might even be able to tell me the subjects of the clauses of the articles. We read article 1, 2, 3 and now we are in article 4 if I'm not mistaken, correct? So can you guys tell me what was the first article?
A qualifying investment fund.
First
No,
article was
in first article it was mentioned like
definitions.
yeah, we should have
No, first
300
article is
million.
definition. No,
Uh,
first article.
will
I'm
okay.
saying
First
articles of the first article was simply
definition.
definition. What was the second article of this decision?
Qualifying investment fund. No.
Condition.
Exemption ki kya what are the conditions of exemption? That was the
Qualifying.
second article. For whom? For
Qualifying
real estate investment trust or qualifying investment fund?
Qualifying investment fund.
Second article was what will be the conditions for a qualifying investment fund to be exempt. What was the third article?
Third article was
Vinay,
REIT.
you remember third article? This was
Third
condition for
article,
exemption. What was the
hmm,
third article?
real estate. Qualifying investment.
Third article was investors. How do we calculate investors' income? How do we exempt? To what part investors' income is exempted, etc. Right? How much of that is included in taxable income? How much of that is exempted? And you're absolutely right. It was bringing into question the immovable property as well. But before the immovable property, it was saying something else of an even more important angle. They were talking about influence and control. Remember 30% rule, 50% rule,
Hmm.
right? That was article 3. How do we calculate investors' income? And then we came to article 4. What was article 4?
REITs. REITs.
REITs. Simple. It was about conditions of exemption for the REITs and it had 8 clauses. We are already on clause uh, 3. Without prejudice to clause 1 of article 3. Now we should be able to tell what is article 3. What was article 3?
Investors.
Investors' income.
Investor.
Investors'
Investor.
income. Without prejudice to clause 1. And can you recall what would be the first clause in that investor income? The initial part of it talked about the various conditions, a default rule. You remember what was the default rule? Default rule was that it will be exempt. The taxable income of a taxable person that is an investor in the qualifying investment fund that is exempt from corporate tax shall be adjusted to exclude, nikal do, to exclude any profit distribution received from the qualifying investment fund. Exclude any profit distribution received. Such a big impact created by only these small words. Actually, just one word. Huge impact created by just one word. What is that word? Keyword. That keyword is received. Do you remember our discussion on other countries, India, Pakistan, and UK and
Yeah.
Europe, etc.? Wherever funds actually distribute profit, you know, smiles come on faces. Everyone is happy. Exemptions start flowing. Reliefs start flowing. This one, because of this one word. Remember this. Okay. So that was the default rule, Article 1. Coming back to where we were. So what was being discussed? Where were we? Yeah, we were talking about this is the clause we were reading, right? Or yeah, Article 4. Sorry, Article 4. We were on Article 4 and we were reading without prejudice to clause 1 of Article 3 of the decision. The taxable income. So, I mean, the clause 1 says that whatever is just received, it will be excluded from the taxable income of the investor. Now read on. The taxable income of a juridical person, that is an investor, in a REIT that is exempt from corporate tax as a qualifying investment fund for the relevant tax period shall be adjusted to include 80%. It sounds very familiar, doesn't it? It shall be adjusted to include 80% of the prorated immovable property income. Such investor may adjust its taxable income to include depreciation adjustment in accordance with clause 8 of Article 3 of this decision. Doesn't it seem very similar? Same thing we read earlier on as well, isn't it? If there is immovable property income, then you can refer back to the uh, clause 8 of Article 3. Exact same conditions that have been mentioned there, they will apply, and the guy will enjoy. He will enjoy the 20% relief. So what was that? Those conditions that distribution should happen. Within 9 months of the financial year. Remember this point? So it is a repeat point.
Mm.
Vinay, remember this?
Yes, it's a repeat.
As an exception to clause 3 of this article, now this clause is being challenged. As an exception to clause 3 of this article, if the real estate investment trust distributes 80% or more of its immovable property income to the investors in relation to the relevant financial year within 9 months of the year, okay, everything met. The income of the investor who did
Mm.
not, yeah, again, repetition. The investor who did not receive this distribution due to the disposal of the ownership interest in the real estate investment trust shall not adjust proportionate to that disposal. So, if it remains undistributed, full income will be included. It's again a repeat from the previous article. It's why are they repeating it? Because the only reason is that because rights are a special type of qualifying investment fund. So what they said was that previous articles were about the overall high level qualifying investment fund. In this article 4, we are going to create specific references for real estate investment trusts, which are still qualifying investment fund, but they are a special kind. So we are going to emphasize this again. So for removal of doubt, even if we have to repeat it, we will repeat it for removal of doubt. So this is again same thing that we have studied before. So if it is undistributed, the entire amount will be included, right? I think by now you should be able to say that, yeah, I think generally speaking, we know the rule about the immovable property. If the fund distributes it, it's all good. If they don't distribute it, problem. Next clause says if the investor disposes of its ownership interest in a real estate investment trust, ah, exact repetition. You remember exemption article, it will not exceed the gains, taxable gains, what's your name, Rafi?
Yeah,
Yeah,
participation
remember
exemption.
we discussed that, okay,
Yes.
whatever was the market value of the, uh, you know, property or the asset, and we sold it at a capital gain, then that will the maximum amount that will be excluded from the taxable income. That's what we read earlier on. in the qualifying
Yeah.
investment fund article.
At the time
And
of
then the
disposal.
next clause, I think same clause. Now repetitions are coming. The tax, that depreciation will be reinstated upon disposal of immovable property or disposal of the ownership interest by the investor. Either of the parties, if either the investment property is sold off, then all the depreciation will come back reinstated. Or alternatively, if the real estate investment, the ownership interests are sold by the investor, in that case also they will have to reinstate the depreciation adjustment. So then comes next clause, which says paragraph A and B of clause 2 of article 2 in this decision shall apply to a real estate investment trust that is exempt from corporate tax as a qualifying investment fund. Now, let me test your memory. What was Article 2 again?
Article 2 was, the first was condition, second was
No, first was
qualifying investment.
definition.
First was definition.
Definition first was
Condition.
condition to exempt the
Perfect. Very good.
qualifying investment fund.
Very good. So, second article was about conditions of exemption of a qualifying investment fund, and it had multiple clauses. I think the very first clause was a default clause. That at a high level this is going to happen. What was that default clause? Let's have a look at it. This was the default clause. The no, okay, I was referring to a different clause. An investment fund, with the exception of real estate investment, shall meet all the following conditions in addition. So it was saying that all the principal business should be investment business. Investors should not run day-to-day business. All information should. This was the default rule. They were saying that these are the conditions, and investment fund with the exception of shall meet all the following conditions in addition to the other article, the mother article of the exemption. Three conditions were provided. This was the first clause, and then further on they were connecting it to the previous clauses. So it is all connected. So coming to the article 4 again, where we were talking about, where were we? Here. Paragraphs A and B. What were the paragraphs? There were three conditions mentioned in this article, right? The easier to remember were, provide all information. That was the third condition, right, to the investor so that he can calculate taxable income. Second condition was, day-to-day operations should not be controlled by the investor. What was the first condition again? Uh, what was the first condition again for Article 2? Okay, that was also an easier one. Principal business or business activities conducted should be investment business and ancillary income. And we remember even the ancillary income de minimis threshold. Do we?
Just
How
5% it was.
5%. Amazing. Good retention. Okay. So here we are again. Paragraph A and B of shall apply to a real estate investment trust that is exempt from corporate tax as a qualifying investment fund, and the reference to resident investment fund in that clause shall be replaced by a reference to real estate investment trust. So there the mention is resident investment fund. Instead of that, we are going to read real estate investment trust, and same article, effectively same article will apply for REITs. Okay, and the A and B, they mentioned A and B, they did not mention providing information to investors. It's a bit strange, but still it addresses A and B of that clause. And A and B was, first was investment business, and the second one was don't control day-to-day affairs. Remember this? That was the, okay. An institutional investor is any of the following. Okay, that's a very important clause. We should understand what exactly is so many places institutional investor was discussed, right? Now it is coming. Government entity, government controlled entity, any juridical person wholly owned or controlled by an entity specified under paragraph A and B of this clause. Subsidiaries of these two, right? And then foreign government, its institutions and authorities of or the juridical person wholly owned or controlled by them. Same things ABC, but for a foreign government. And then international organizations, then Wow. A bank, even a bank is included. Insurance, wow. Insurance provider is also included. Pension Social Security Fund is also included. Investment fund licensed and regulated by, do you remember the most famous investment fund of UAE?
The recent one.
Mubadla.
Mubadala. Amazing. Yes, Mubadala is there. IHC might not be in it.
IHC.
IHC is also, I'm not sure if it is a sovereign wealth fund or only, but anyways, Mubadala for sure. Adia is there. And I think even IHC is an investment fund.
But
But we,
IHC has like a lot of subsidiary companies.
oh, huge, huge, huge. Uh, I don't know if it is hundreds or it is thousands, but I
Mm,
think it is in thousands.
mm,
I think 200, less than 300 companies are subsidiaries of Aldar only. It's a huge, it's a giant IC.
mm.
1 point, pata nahi, 2 or something trillion dollars market cap. Okay, anyways, an investment fund licensed and regulated by a relevant competent authority or a similar regulatory authority in or outside the UAE and any other juridical person determined by the authority. So now anybody asks you that who is an institutional investor, are you able to answer? If you develop a mind map of this, how will you develop it? How many A, B, C, D, E, F, G, H, I, J? 10 things are mentioned here, but you can squeeze them into smaller. Can I give
The
you a
first
hint?
is government. Yeah.
This is one category until here. This is a separate category, but similar to this, right? This is a standalone category, but all three of them are under one sector. We call it BFSI, banking, financial services, and insurance. This is all BFSI. Then we have this investment fund. Actually, you could even club it with BFSI, but I'll keep it separate because this is a topic of corporate tax law. An investment fund licensed by the whatever, and then there's any other. So if you really think about it, we have one category, two category, three, four, and five. You have to remember five, not 10. If you remember five, you will remember what is institutional investor. So who's going to repeat from memory without looking
So
at it? Yeah,
me.
please.
Sir, it's government entity, government controlled entity, and then any juridical person, and then coming
Subsidiaries,
towards
na? Subsidiaries.
sub
Subsidiaries of the above
subsidiary.
two.
Then yeah, then coming towards bank, insurance
You
provider.
forgot foreign government. Same things for foreign government as well. You know, government
Uh,
entity, controlled entity, or their subsidiaries for foreign
okay,
government as
and
well. Yeah,
foreign
carry on.
government and any international organization,
Okay.
and then bank, insurance provider, and
Under BFSI, we have three categories: bank,
yes,
insurance provider, then
and
pension,
social
social security fund.
pension fund.
Okay,
That's it.
perfect. Okay, one more thing was investment fund itself.
Mm.
An investment fund, I kept it separate. Why? Because this is corporate tax has a separate discussion on it. Okay, so excellent. You guys have read it very well. Article 4. Um, this is probably the last, you know, major topic of this decision, qualifying limited partnerships. And then after that, the smaller, this is it. I mean, after that, it's only a 2 minute topic discussion. Shall we quickly finish this also?
Yes.
Qualifying
And
it
then we
limit.
can.
Yeah.
Mm.
Okay, so and we have less time also, so we'll qualifying limited partnership. I think by the end of our time today, we will finish this decision, and then we'll move on in the next session, inshallah, next Saturday. Qualifying limited partnership. A qualifying limited partnership may apply for to the authority to be exempt from corporate tax where all of the following conditions are met. What is a qualifying limited partnership, by the way? It is a limited
It's
liability. First thing is, yeah, easy hanging
LLP.
fruit, na, limited partnership. First, say, okay, common sense tells me that it's an LLP first of all. Then there is a prefix qualifying, so that means there are certain conditions. And okay, maybe it is defined, yes, but the detailed discussion we are going to read. So we can go ahead and read it. But anyways, qualifying limited
Sir, I have
partnership.
a question.
Yes.
Sir, in UAE, like how to identify a company, like it is limited liability partnership, because if it is FZ company, FZC, then we have establishments, but how to
Yeah, no,
identify?
yeah. Good. So LLP is a particular status that is granted by very limited free zones. I think only these three that I mentioned, DIFC, ADGM, and RAC ICC, probably, I'm not sure whether DMCC has it or not. It could, because it also has a stock exchange, although it's a commodity stock exchange, but still DMCC may have it. But nonetheless, the point is that these three financial free zones, they do offer this, LLP uh, vehicle. They do offer it.
SP.
Other than other free zones, they don't. Okay.
So the name of the company
Will
plus
be
LLP it will be.
LLP. It will be either LLP or limited partnership. Okay. A limited partnership, that is a juridical person established pursuant to the relevant legislation. So these free zones have their legislation. And mainland also has it, but I'm not sure if mainland has an LLP structure in force in the state for the sole purpose of collective investment. That's a key point here. In the definition, they have brought it as a key factor of the definition, that this LLP has to be has to have as their objects clause collective investment under a legal framework that explicitly allowed for establishment of such partnership on or before 1 June 2023, or any other legal framework as may be prescribed by the minister. So that's the definition of limited partnership, qualifying limited partnership. But the greater discussion we are doing now, right, may apply to be exempt where they meet all the three conditions. Principal business to business activity of the collective limited partnership is investment business. Do you remember this? Two places, two times this has been revised, has been stated. This is probably the third time it is being produced. So it's an easy one to remember because you've read it. And any other ancillary business, etc. Second, qualifying limited partnership does not derive any income from a right in rem sale, etc., from exploitation of immovable property located. This limited partnership is prohibited from undertaking immovable property business related income. Clear, guys? This memory hook can help you discern the scope of limited partnership from real estate investment trust or qualifying investment fund. Now remember, qualifying investment fund is the superset. The subsets of it are real estate investment trust as well as qualifying limited partnerships. But this limited partnership cannot undertake immovable property business. The main or principal purpose of the qualified limited partnership is not to avoid corporate tax. Okay, many places this point has been repeated. But can I ask from, let's see your memory, where is this type of a clause mentioned? The principal objective is not to avoid tax, corporate
Sir, in
tax.
Article 2 also. In
Article
Article 2.
Article 2 of this decision.
Yeah, like when we were reading the qualifying investment fund also.
Where were we reading it? In this decision, or was it in corporate
Yes.
tax law, mother law?
Sir, if no, in this decision also.
Okay,
In
okay,
this decision. In
okay, okay,
corporate tax law, mother article it is there.
okay. This is the Article 2, right? This is Article 2. Now, can you see that tax avoidance has been addressed here? This is the first article. It has not been addressed here.
Hmm.
This is the second article. Uh, Apparently, I'm looking at the clauses. The specific words of tax avoidance or principle should not be to avoid tax has not been mentioned. It does not. It is not there in Article 2. It is also not there in Article 3. I will tell you, actually, we read it in here, in the mother law. Rafi, do you remember Article 10? You said 2 points to remember. It should be regulated, it should be publicly available. Remember, Rafi? Hello, Rafi, are you there?
I was yes, I remember. It is on Article 9.
No, it is in Article 10. You mentioned two things for us to remember, which were the main points, but then I mentioned third point is also there.
The 2 points was like it should be publicly
Two are
available.
the main points because this is a common sense point. The tax avoidance is a common sense point. These are particular points, specific points that should be highly regulated and publicly available, recognized stock exchange, right? And you try to remember it by a recognized stock exchange reference rather than publicly available. Publicly available can be over the counter as well. It has a different meaning. So try to remember the second one with reference to recognized stock exchange.
Traded on recognized stock exchange.
Okay, because publicly available, sometimes you can buy shares of Emirates NBD or any other RTA by going to Emirates NBD counter saying that I need to purchase the shares of RTA. Can you please help me out? And the ENBD or Mashreq Bank, all these banks counters are going to help you. It is not traded on stock exchange, but still publicly available. That's called an offer for sale. Anyways, we'll not get into the corporate law right now. So anyways, you guys, you're with me until now. So this tax avoidance has not been mentioned in the Article 2 or 3 or 4 as such specifically. Indirectly it is, but directly it is mentioned in Article 10 of the mother law. Okay, Vinay?
Yes, sir.
Right. So yeah, where was I? Yeah, the main purpose is not avoidance. A juridical person wholly, directly or indirectly owned and controlled by now this is all continuation, right? These are okay, this is the second point. A juridical person wholly directly or indirectly owned and controlled by a qualifying limited partnership that is exempt from corporate tax may apply to the authority to be exempt from corporate tax where it meets all of the following conditions. Now again, yeah, this is a very interesting point, not mentioned anywhere at all in the entire corporate tax law. So pay attention to this, huh? You will not find this anywhere else. So what are we talking about in this article? Do you know what we're talking about? We are talking about a subsidiary of an LLP. Got it? Guys?
Yes, sir.
Okay. So a juridical person wholly directly or indirectly owned and controlled by a qualifying limited partnership that is exempt from corporate tax may apply for exemption itself. यानी कि even the subsidiary of an LLP can be exempt if provided that this is a qualifying limited partnership where it meets the conditions. What conditions? And now this definitely will be easy for you now. It conducts any of the following activities. One, only undertakes part or whole of the activities of the qualifying limited partnership. I will tell you something of a memory test, but I am not sure if you guys will be able to answer. But let me try to ask you this. This has been reproduced. It is already available somewhere in any of the parts of the corporate tax law. And law comprises of mother law, decisions, cabinet decision, ministerial decision, all of that. But the majority of it is in the mother law. So can you recall these things somewhere mentioned already? It conducts any of the following activity, only undertakes part or whole of the activity of the qualifying limited partnership, meaning it's a mirror image of the limited partnership. It does the same things or at least ancillary things. Is engaged exclusively in holding assets or investing funds for the benefit of the qualifying limited partnerships. Okay, in first case it was an operational entity. In the second case it is only a treasury SPV for the parent company. You getting my point? Clear?
Yes.
Only carries out activities that are ancillary to those carried out by the qualifying limited partnership. Can you recall similar things being mentioned somewhere else in the corporate tax law? Mr. Vinay?
So with these three highlighted points.
Yeah, the ones that I highlighted only.
Okay. No, sir.
Do you know which is this article? This is the mother article of exemption, Article 4 in the corporate tax decree law, FDL 47. Rafi, are you there or are you muted? Rafi, you're muted, brother. Okay, Rafi is muted, but anyways, let me repeat. Let me talk to you, Vinay.
Yes.
In the mother article, we had so many different categories, right? One of the
Hmm.
categories was subsidiaries. You remember?
Yes, sir.
Yeah, of A, B, F, and G. You know, A, B was government entities, government controlled entities, and then there was F and G, different were there. F was qualifying investment fund, and G was a pension social security fund. If they had subsidiaries and they undertake part or whole of the activities of those companies, government entity, government controlled entity, or investment fund, or public or private pension and social security fund, if they undertook part or whole of the same, is engaged exclusively in holding assets or investing funds, SPV situation, or thirdly ancillary activities.
Hmm.
Same thing has been reproduced here, replica. Can you see? The only difference
Yes, sir.
is it is subsidiary of only one entity, one type, qualifying limited partnership. Okay, that will, if they do that, if the subsidiaries perform the same things, then they will also qualify or be eligible for exemption. Clear?
Yes, got it.
It does not derive any income from a right in rem, sale, assignment, etc., for from the exploitation of the immovable property located in the UAE. If there is an investment immovable property that is located in UAE, these entities, subsidiaries, they don't deal with this. This is a repetition from the main entity. They don't write in rem, sale, etc. Neither holding company is allowed to deal in real estate, nor subsidiary is allowed. Clear?
Yes.
Okay. Then the third article, for the purposes of applying paragraph A of clause 1 of this article. What was clause 1? This was the clause 1. Paragraph A was that it should conduct investment business. For the purposes of applying, again it is a repetition. Uh, the following provisions shall apply where the business or business activities of the resident investment manager are attributed to a qualifying limited partnership. Taxable income of the investment manager will be adjusted to include the net income attributed to qualifying limited partnership from such business or business activities in accordance with Article 20 of the Corporate Tax Law. So it is saying that whatever income is attributed, and this is talking about the investment manager. This article is about investment manager, resident investment manager. So that investment manager, when he's preparing his corporate tax return, he will include or that company will include the income that comes from the investment business of such qualifying limited partnership shall be adjusted to include the net income attributable to qualified limited partnership from such business in accordance with Article 20. Okay, Article 20, we know that it is the main article which guides how to transform the profit before tax to taxable income, right? What adjustments are there? Remember realization adjustment, or etc., etc., exempt income and all that. So that this is a simple article of saying, of advising to tax the income of the investment manager when he is preparing his return. Second, B clause, the business or business activities of an investment manager that are attributed to that qualifying limited partnership shall be considered to be investment business where they meet at least one or both of the following conditions. Two conditions have been identified here. Uh, So the question is, to interpret this clause, we can say that how will we know if the investment manager is actually conducting investment business, right, Vinay?
Yes. Yes,
So the
sir.
answer is given by these two. If he is doing these things, then it will be investment business. If the activities are subject to corporate tax law in the UAE through that investment manager, that's first. Second, they are undertaken by the investment manager that would meet the conditions under clause 1 of Article 15. What were those conditions of the investment manager? It should that person should be regulated. That person should, you
Yeah.
know, many things were mentioned in the clause 1 of Article 15, investment manager's exemption. That was, uh, the whole point was that it will not constitute a permanent establishment of the non-resident person, provided that the reference to the non-resident person is replaced by qualifying limited partnership. So if you go to that Article 15, all you need to do is to change the words of non-resident person and read it as qualifying limited partnership. So that let me reach the Article 5. Yeah, here it is. All of these clauses were the conditions for investment manager's exemption to come into play. Investment manager engaged in the business of providing investment brokerage services, subject to regulatory oversight. It is normal course of business, independent capacity, arm's length principle. All of these conditions were there, had to be met, so that the investment manager does not create a permanent establishment for non-resident person.
Sir, I have a question in this.
Yes.
Does the investment manager needs to apply for exemption from corporate tax on his individual income, or like how?
Uh, so wherever, see, the default mechanism of corporate tax law is that uh, and as practitioners also we always advise you should apply, right, for exemption. If it is not, so how do you say, this is a negative assurance. If it is written expressly in the corporate tax law
Hmm.
that this person will be exempt, no need to notify, no need to file a declaration. But you need to understand something. This article is not about the exemption given to investment manager. Don't
Yes.
misinterpret this article. The title of this article can be misleading. What does it sound like? That the
Investment
investment manager
manager.
is exempt. This is the sound of it, is it?
Yes.
It's not the meaning of it. Do you know what is the meaning of this article? The meaning
For
of this
the
article is,
NI,
huh?
non-residents.
Exactly.
Like the non-residents acting from India, okay, and he is keeping one investment manager
Huh.
or an investment management company. So that person is not creating the PE in
PE.
UAE, so
Yes.
that NRI is not taxable.
That was the purpose of this article. So that exemption is not really for the investment manager. It is
Yes,
for the
yes, got it.
non-resident person,
Got it.
right? So we should remember. Now, does this answer your question?
Yes, sir.
Okay. So, where were we? Yeah. So we were saying that, all we need to do is to change the word non-resident person to qualifying limited partnership in that clause, and it will start to make sense. The business shall be attributed to a qualifying limited partnership, shall be considered investment manager's investment business where they meet the condition. Okay. What else is there? A few more paragraphs and today's session will end. So I know you guys are exhausted by now. Anyways, now,
Sir, one more thing is there.
yeah,
Sir, have you covered the family foundation? No?
no, it will come Article 16.
Okay, because in family foundation also like there is a same clarification
Yeah, yeah.
issued by FTA.
We will go into detail. Don't worry. We'll go into detail.
Okay,
We'll
sir.
not leave
Okay, sir.
anything.
Thank
Okay.
you, sir.
No, inshallah, once you have gone through this course with me, hopefully uh, you will learn corporate tax. You'll be able to practice well. Okay. Anyways, any other business or business activities that the qualifying limited partnership conducts shall be considered ancillary or incidental. Now, this paragraph talks about what is ancillary or incidental, and same thing, 5% de minimis rule. No complication. You remember what was the 5% rule?
That's de minimis.
Yeah, but what was it? The
Should not exceed
it is
5% of the total revenue. It should be
total.
below 5%, the investment
Does
income.
no, the rule is that what are we talking about? We're talking about exemption, right?
Hmm.
Whose exemption? Qualifying limited partnerships exemption, correct?
Yes.
So, I mean, even if we are not very intelligent. Assume we are not intelligent people. We are barely able to remember things, right? But even at that level, if somebody asks you how and when exactly is a qualifying limited partnership exempt, when does it get exemption? What will be your common sense, very high level answer? Certain
The
conditions they
investment
have
value
to
should
meet, right?
exceed.
Yes.
What broad level conditions are there? The biggest condition, first condition, they have to be doing investment business, correct?
Yes.
And in that condition of investment business, there was one small leeway also provided. Okay, they can do other business as well, which is ancillary business, but it cannot exceed how much amount
5%.
of the
5%.
total revenue? That's the only thing that we should remember. That this is it. This is the de minimis rule in the qualifying limited partnerships and qualifying investment and real estate. you know so it is a repeat. It
Even
cannot
in qualifying prison also, the same concept has been.
same concept is in qualifying. De minimis is a very frequently used concept. When you study pillar 2, you will see that too many places this de minimis concept has come in.
That has 5%, 5 million, right? Free zones.
Oh, that's a different rule. Yeah, yeah,
Whichever
yeah,
is
yeah.
lower.
Yeah, whichever is lower, that's a different rule. So they have given two legs to
Mm.
test the de minimis.
And
So
for the
here it
investment
is
fund
not
and REITs, yeah. So this one only 5% of the auxiliary
5% of the total revenue.
revenue,
The ancillary business cannot exceed 5% of the total revenue. Okay.
total
Yeah.
revenue, yeah.
The taxable income of a taxable person, that is an investor in a qualifying limited partnership, that is exempt from corporate tax. Now, why did they include this as a paragraph here instead of creating a separate heading? Do you remember that we had a full article on this earlier on? Which was that article in this decision? Article number 3. Yeah,
Three,
come on.
investment.
Develop a mind map. Article
Yeah.
number 1 is definition.
Definition. Second one is
Article 2
condition.
is condition. Article 3
Condition
is
Investor.
and
investors income,
for
how
the
to calculate
investor.
investors taxable income, correct?
Yeah,
Yes.
yeah.
Then article 4 was there. What was article 4? Real
REIT.
estate investment trust,
REIT, yeah.
REITs. Then article 5 was there that we are studying right now.
No. Qualifying.
Article 5, qualifying limited partnership, right? It's an easy mind map, not to be forgotten, right? So yeah, where were we? Yeah, my question is why they did not create a separate separate article for this. They didn't want to. They said, okay, we'll just simply club it inside itself. Otherwise we created a separate article for it, for the qualifying investment fund. So the taxable income of a taxable person, that is an investor in a qualifying limited that is exempt from corporate tax, shall be adjusted to exclude any profit distributions. What was the keyword?
Received.
Remember this discussion?
Yes.
Yeah. So if actually received, then khali wali, enjoy the exclusion. All exempt shall be adjusted to exclude. But that, my dear friends, is only the default rule. They don't leave you that easy. They will always create some exceptions. So what is that exception? Without prejudice to clause 5. Here it comes. Without prejudice to clause 5 of this article and article 22. This article 22 talks about exempt income of the corporate tax law. Taxable income of a juridical person, that is a taxable person, and that is an investor in a qualifying limited partnership, that is exempt from corporate tax. So we are talking about taxing the income of qualifying limited partnership in the hands of the investor. So we are treating this qualifying limited partnership as a transparent entity or flow through entity, and that is investor for the relevant tax period shall be adjusted to include the prorated net income of the qualifying limited partnership and any juridical person that is exempt from corporate tax and wholly, directly or indirectly owned and controlled by the qualifying limited partnership. So in short, this is the subsidiary whole of the qualifying limited. So if income comes either from qualifying limited partnerships or their subsidiary and it reaches the hands of the investor, it will be excluded if it meets all the exemption conditions. It's as simple as that. Okay. And in proportion to the ownership interest in the investor after deducting the income attributable to investment manager. So, but yeah, we will we will remove the commissions and revenue shares of the investment manager, and after that we will either exempt or tax it. Let's read one more time. The taxable, without prejudice to clause 5, the taxable income of a juridical person, that is a taxable person, and that is an investor in a qualifying limited partnership that is exempt from corporate tax for the relevant tax period, shall be adjusted to include the prorated net income of the qualifying limited partnership. Okay, that creates a question mark. Prorated net income of the qualifying limited partnership and any juridical person that is exempt from the subsidiary as reflected in the financial statement, and the proportion of the ownership interest of the owner, and after deduct. So to the extent of the ownership interest, let's say there are 10 investors, so only 10% of the overall bottom line of the qualifying limited partnership plus its subsidiaries will be considered as the income of the investor. And naturally, so chances are that there may come something, but we'll see about that. And we will apply the default Article 20, which helps us to calculate the taxable income. Let us read through, because I want to know whether they have spoken anything more on the prorated income of the qualifying limited partnership. Have they mentioned anything in here before for prorated income? Nothing as yet. So maybe it's coming ahead. Principal business, yeah, nothing yet. Prorated, I think by then it will mean simply application of the percentage of ownership to the overall income of the qualifying limited partnership. Okay, where were we? What was the last thing we read until now? Article, uh, yeah, this one, Article 6. Let's read Article 7. If nothing is mentioned, that means that immovable property complications, etc., they will never come into play here. Anyways, it is prohibited. So I think the prorated becomes very easy to understand now. That it is simply whatever is the bottom line of the qualifying limited partnership, multiply it with the shareholding percentage, ownership percentage of the investor, and that will be the share of investor taxed in the books of the investor. Where the investor in a qualifying limited partnership that is an exempt from corporate tax, and when we say exempt from corporate tax, we're saying that it will not be taxed at entity level, is a non-resident person. It may appoint directly or through a qualifying limited partnership or its investor a tax agent. Repetition. So it, I mean, same thing. A QLP can also appoint a tax agent. Then I'm sure this will also be a repetition. Qualifying limited partnership does not make an application. If a qualifying limited partnership does not make an application to the authority to be exempt from corporate tax, Vinay, does this answer your question?
Yes, sir.
Remember your question?
Yes, no.
Does not make an application to the authority to be exempt from corporate tax during the first tax period in which this decision applies to it, or fails to meet any of the conditions set out in clause 1 of this article throughout a tax period, it shall cease to be an exempt person. My God, that's a dangerous clause.
Same like qualifying reason.
Exactly. Like if they, and it's even tougher, yeah, Vinay. Think
Mm,
about it. It's even tougher.
yes.
If a qualifying limited partnership does not make an application to the authority to be exempt from the corporate tax during the first tax period in which this decision applies. My God, isn't it
And
very
first tax,
harsh? Huh?
and first tax corporate period, like actually over, for example. So
Ah,
now, if they are not
no, no,
aware of
no,
this
no, no, no.
provision,
Here it says to which this decision applies. Corporate tax period in which this decision applies to it.
mm,
You see my point? A qualifying limited
Yes, sir.
partnership may be formed only in 2026. Corporate tax law has been in place since 2023. And this
Yes.
decision is also of 2024, 25, I think. But anyways, yeah. So what
Okay.
about those qualifying limited partnerships that have been formed in 2026, right?
Okay.
So if naturally, I mean, once they form, they're meeting conditions, the decision will start to apply to them, correct?
Hmm.
But they have to make an application, but they fail to do so. They don't make the application, or it fails to,
Hmm.
or alternatively, they are not meeting certain conditions throughout a tax period. It shall cease to be an exempt person as qualifying limited partnership from the beginning of the relevant tax period and for the subsequent 4 tax periods. Yeah, this is, you're right. This is similar to qualifying free zone person embargo that is implemented through that ministerial decision, right? So there are
Yes.
in for qualifying free zone person, there's a cabinet decision, and then there is a ministerial decision as well, right? Which gives the details of the qualifying activities and excluded activities. If I remember correctly, this 4-year condition has been given in the ministerial decision rather than cabinet decision. So, but what's your name, Rafi? Is this point clear to you? Do you understand what is being discussed here?
Yeah, it's a similar as other
QFGP.
like we have to apply. Yeah.
Yeah. So until for 5 years loss. So, only
Yeah.
after the completion of the 5 years, current year plus 4 years, after that they can apply for exemption. Okay. Where a qualifying limited partnership ceases to be an exempt person pursuant to clause 8 because of this clause of the article, its opening value for corporate tax purposes shall be as follows. Now, opening value for assets and liabilities held before the first tax period in which the qualifying limited partnership became an exempt person and still held at the start of that tax period, the opening value shall be the closing balance sheet prepared for the financial reporting purposes under the accounting standards applied in the state on the last day of the financial year that ends immediately before the first tax period in which it becomes an exempt person, and any subsequent capitalized costs incurred during the tax period in which it was an exempt person are subject to an arm's length principle and subject to any condition or adjustments as prescribed by the minister. Do you guys recall at least reading this or hearing this type of discussion anywhere at all, that the opening balances should be on fair value, arm's length principle should be complied with, etc., etc.? Have you heard about this?
Yes, that are the conditions to be met in qualifying free zone also. This is what I can recall.
Okay, let me ask Rafi also, then I will answer. Rafi, have you heard this discussion about opening values or opening balance sheet?
No, sir.
No. Actually,
No.
Articles?
this is a matter of transitional provisions.
Mm-hmm.
You
Right.
remember? It is addressed
Yes,
in
yes, yes.
the mother law, and later on there was a decision, ministerial decision, I think 140, if I remember correctly, or 144. But this is transitional provision. There you go. Transitional rules. Uh, taxable opening balance sheet for the corporate tax purpose shall be the closing balance sheet. Can you see this? Article 61.
Mm-hmm.
This is the mother law.
Mm-hmm.
Same thing has been repeated. Opening balance sheet prepared for financial reporting purposes under accounting standards applied in the state on the last days of the financial year that ends immediately before the first tax year, subject to condition and adjustments as may be prescribed. Opening shall be prepared taking into arm's length principle. Isn't this a repetition of this?
Mm-hmm.
This is all a repetition. Oh, arm's length principle, closing balance of the last previous year, etc., etc. But even if it is, even if you don't read this, na, common sense will tell you that, even if we come in with an opening balance sheet that could later on have an impact on our corporate tax return of that particular year to which that opening balance sheet corresponds to that opening balance sheet will also be subject to scrutiny. Don't you agree, Rafi?
Yeah, correct.
And
Sir, can
why
I
do,
give you
sorry?
an example of this?
Yes,
Can I
please.
give you
Yeah,
example
yeah,
of
yeah,
this?
please, please, please.
Sir, because one of the company currently being audited for the financial year 2024, okay, and the Article 61 also,
Mm-hmm.
FTA checked it,
Hmm.
the loans from the related party, yeah,
Perfect.
it should be yeah, reinstated at arm's length, okay, as on 1st January 2024, okay, and everything. And now during the audit, the the related party balances and the interest was not at arm's length, the transitional as on 1 January 2024.
Very good.
Okay,
Perfect
so
example.
that company was hit by this Article
Very good.
60.
Very good. Let's say this transitional rule was not there, Vinay. Yeah.
Yeah.
Ministry of Finance forgot about it and they did a mistake. They did not address this principle. Can you construct a tax fraud, tax avoidance fraud?
Yeah.
Tell me.
Yeah.
Tell me. What kind of a fraud will you construct?
So the like the outstanding balance which was there now, and now due to this transfer pricing,
So
uh,
let's say a company, qualifying limited partnership has been formed on 1 July 2026. No,
okay,
okay, hold on. No, that's not right. The qualifying limited partnership has been in existence from many years, since 2023. It is a running concern, going concern. Okay. This, what do you say? This decision has just come into play, and uh, whatever is the opening date of this decision, the company is required to prepare an opening balance sheet for their financial affairs, like opening balance sheet and income statement, etc. How would they manipulate the figures so that they could benefit in the tax year from 1 July 2026 until 30th June? They have a special tax period, which starts from 1 July and on 30th June. How would they manipulate the closing balance sheet of the previous year? Rafi, you want to say something?
No.
yeah, sir,
I'm
can
still.
I say, sir, can I say?
Yeah, please.
Mm, so before introduction of CT, okay, so there was no concept of arm's length and all these things. So
Very
they
good.
would never show the interest at the standard benchmark rate, or it will be like a interest-free loan. They can show uh, like this.
Okay. Multiple ways are there. Let me give. There are multiple ways. See, one could be understatement of income. The other could be overstatement of income. So I want to construct a fraud with two different approaches, two frauds. Actually, I can continue to create multiple, but anyways, let's restrict this discussion. First fraud is intercompany sales. I am the seller, my subsidiary is the buyer. Rafi, are you with me?
Yeah, I'm still. Yeah.
Yeah. So I have really bumped up my sales to my subsidiary in the pre decision period. Okay. Uh, we are assuming that the transitional rules for corporate tax law itself are not applicable, right? And this decision has ignored that angle as well. Now, what I'm going to do is I'm going to beef up my receivables in the balance sheet, have huge receivables I've created, fake receivables, right? And in the year 2026-27, I will claim the expected credit loss adjustment or benefit or write-off. I'll say, oh, I'm sorry, our subsidiary has gone bankrupt or they're not able to fulfill. So auditors will calculate and say, yeah, this is an irrecoverable debt. So a fake level of irrecoverable debt claimed during the year. That's one fraud. Second fraud, uh, the loan was given by our parent company to a subsidiary, which Vinay, you rightly pointed out. It was an interest-free loan, and and no interest was, so the tax base of the interest receivable was basically zero in the opening balance sheet,
Yes,
right?
yes, right.
So that's also another angle. If we let's say if we are not able to recover that, and if this is true that the subsidiary has gone bankrupt, then that should have been written off. But FTA will be happy that okay, they did not claim an expense. But it could be the other way around itself as well. You know, I would ask my subsidiary to lend loan to the parent company, heavy loan, right? And I will start booking heavy amount of interest on it. What will happen to my profit before tax? It will go down,
Reduce, it will reduce.
hugely go down. Was this real? No.
No,
It was totally artificial to create a tax advantage. So these are some examples of why the opening balance sheet compliance is very important, just to ensure that the arm's length principle is complied with. Anyways, let's move forward. We have 5 minutes left only.
And provided the money which is borrowed should be for the, okay, that can be done
This is
anything. All right, go ahead.
this
Yeah.
is a, let me tell you, Rafi, what I have just embarked upon or touched, barely touched the surface. This is an iceberg. I have not even touched the tip of it. Thin capitalization is a century-old fraud. This is
Mm-hmm.
called thin capitalization. And this is the biggest fraud that has been there for a century between related parties and even sometimes non-related parties. So fraudulent activity through which cushions are created and profits are manipulated. We will talk about this in detail when the time comes, inshallah. Okay. For assets and liabilities acquired during the tax period, which qualifying limited partnership was an exempt person, the opening value shall be the cost. So the cost of the assets and liabilities, that will be the opening value. So this is being very transparent. If we take cost as the opening, then it will leave little margin for manipulation as specified in the accounting standards. If you follow IFRS to the letter, actually you cannot even violate arm's length principle. You know, honestly
yes, yes,
speaking,
right.
if you
Yes,
follow IFRS to the letter, even IFRS talk about related party. There's IAS 24 on related party. But
but
anyways,
it, but earlier in UAE, like no one was following this arm's length or this
it was
in
a
case of.
non-regulated economy, my dear.
Yeah, yeah,
So
yeah, not right.
what do you expect? Now
Yes,
the
and
things
people.
have like drastically changed. You know, in January of 2026, if I remember correctly, so many jurisdictions had removed UAE from gray list. One more, the major jurisdiction was EU, European Union.
Yeah.
Even they removed UAE from gray list at the beginning of
Yes.
2026, which is a great achievement. So, we can feel it as tax practitioners. The level of regulation has skyrocketed, has it not? It has, right? So it is a far better jurisdiction than it was before. A qualifying limited partnership that does not make an application to the authority. Oh, I think I read this. Uh, Ceases to be an exempt person and apply to the authority to be exempt under any other exemptions available. Okay, a qualifying limited partnership that does not make an application to the authority to be exempt from the corporate tax pursuant to clause 1 of this article or fails to meet the conditions throughout the tax period ceases to be an exempt person. Uh, uh, Ceases to be an exempt person may apply to the authority to be exempt from corporate tax under any other exemption. Yeah, so okay, this exemption will be gone, but it can still claim other exemption if the law allows it. Okay. Last clause of this thing, uh, qualifying limited partner, clause 8 to 10 of this article, 8, 9, 10, these are the three clauses that we just saw. What was this clause? Fails to meet that 5-year ban. 5-year ban was the 8, then opening balance sheet and all that, and then other exemptions. Clause 8 to 10 shall apply to the juridical person referred to in clause 2 of this article. I think they're talking about subsidiaries. Clause 2 of this article. Clause 2 of this article. Yeah, subsidiaries wholly or controlled by the qualifying limited partner, subsidiaries of the QLP. It will also apply to the subsidiaries. Uh, Clause 2 of this article, and reference in clause 8 and 10 of the shall be replaced with the reference in clause 2. So, okay, fine, understood. Same things will apply to the subsidiaries as well. Clear, guys? Last
Yes,
topic
yeah.
of this unincorporated partnerships, Article 6.
So
Rest
this
of it
we
is
can cover.
uh,
Yeah,
it's
sir.
it's done, finished. The
Because
decision is
like
over.
unincorporated is like very huge.
No, hold on. It is coming from a different perspective here. Unincorporated has a separate
Okay, okay.
decision. An unincorporated partnership that is treated as a taxable person in its own right in accordance with clause 8 of article 16. You remember that a UIP, unincorporated partnership, can make an application to the federal tax authority that please as tax us at entity level.
Yes.
Yeah, it can make an application, right? When we reach an incorporated partnership, we're going to know about this more, but they can be taxed at entity level after an application and approval of the corporate tax law. But and that if it is that kind of that unincorporated partnership which has been approved by the authority that yes, we are going to tax you at entity level, then it shall be considered an entity under the definition of a qualifying investment fund. It sounds so easy and simple, right? Vinay and Rafi.
Yes, sir.
But
Mm-hmm.
can you imagine the repercussions of this one small clause? This unincorporated partnership, which was going very easy in the default treatment because it is not taxed actually. It is seen as a tax transparent entity. The income flows through into the hands of the partners, and that is where it is considered for taxation. That was the original idea of an incorporated partnership. But then law created an exception that if the partners apply to FTA saying that please tax us at entity level, then FTA can consider and approve. But if that happens, then whatever we have read in this entire decision will apply to that unincorporated partnership. If those partners are not tax savvy and they're like simple, they'll be so much afraid to do this because of this decision that they're going to say hell with it, we are going to follow the default treatment of unincorporated partnerships. We are not going to have us taxed at entity level. Is this point clear, guys?
Yes.
An
Mm-hmm.
unincorporated partnership may apply to the authority to be exempt from corporate tax as a qualifying investment fund, provided that all the relevant conditions specified in corporate tax law and the decisions are met. Boss, don't take this Article 6 lightly. This is a huge article. If you carefully imagine the repercussions of this, you will find in practical real life that how are Rafi, you are sitting in a probably a services concern, and Vinay is also, mashallah, doing very well. You guys must have seen certain partnerships being formed simply on a piece of paper, right?
Yes.
Yeah, simply two people sign an agreement that okay, this is a partnership,
Yeah.
this is how it will be, this and that, and it becomes a partnership. Then they go to the notary public, they say, okay, this is our agreement, can you please register it with you, notarize it, this and that, and it is formally registered as an unincorporated partnership, right? They might not even go to a notary public, chances are, but that we can see from the guide whether notarization is a condition or not. But the point is, in spirit, an unincorporated partnership is formed when they sign that partnership contract. Two people like you and me, sitting somewhere in a cafe, they will sign a contract, and unincorporated partnership will be bond. right? But then complications will come and they will start analyzing that what business are we in? Is it investment business or is it something else? And suddenly they find out, oh gosh, boss, you and I both are brokers, we are investors, and we are actually into investment business. Isn't there a way that we can get ourselves like really, really exempted from everything? And they will go to this decision. They will go and they will reach Article 6. That's where the corporate tax strategy expertise will creep in. So I'm not trying to make you guys simple compliance people. You guys are destined to become corporate tax strategists, to learn the strategy aspects of it. By reading these two clauses, you can anticipate that if those two individuals were doing, or for that matter, those two individuals had their own entities as well, legal entities, and they, they had an unincorporated partnership, they are going to have to create all the scenarios at that time. Don't you think so? They'll see that is it beneficial for us to do it at entity level, because then this entire article will the decision will apply, and if the decision apply, then we will not be seen as something else, we'll be seen as a qualifying investment fund, and then they will go into all the articles related to qualifying investment fund. You see my point? This is the height of corporate tax strategy. So imagine this and later on brood upon it as to how and what advantages and advices you can give to such individuals who are entering into unincorporated partnership agreements. Exempt
Sir,
from
I
government.
have a question in this.
Yes,
Sorry. Sir, don't you think that, like, if I'm talking on a layman aspect, like if I'm having an unincorporated partnership and I'm entering into qualifying investment fund where it needs to be regulated and it should be recognized on a stock market. So, what do you think? Because the stock market will, as per my knowledge, they will never list a company which is unincorporated. So,
correct.
what do you
And yes, so before flight, they will be shot down. Yeah,
think?
so you're right. There are too many conditions. It is, chances are, I mean, unincorporated partnerships might not fly, but I mean, more and more, the whole idea, see, sometimes what happens is we might not immediately be able to identify the repercussions. And then during the course of the practice, some scenario will come to us, and we will suddenly speak, say out loud, Eureka! Wow, deja vu, something new discovered. It just clicked our mind that it can be seen in a different manner. So it is important. This text-based learning and discussion is very important for us to create new things out of the blue. So, I mean, you're right, absolutely. You immediately curbed this, that in order to become a, but Vinay, don't you think there's another thing mentioned here? Uh, where was it? Yeah. What is this written?
Shall be considered, shall be
Shall be
considered, shall be
considered
cons
an
hmm,
entity under the definition of the qualifying investment fund. Doesn't the lawmaker know that this is an unincorporated partnership?
yes, they know.
And naturally, it doesn't have any shares, and it cannot be listed or anything. That
Yes,
person
but I
knows,
don't think so.
lawmaker knows. Still, they said that it will be considered as an entity under the qualifying investment fund.
But sir, but if you your DIFC, I don't think so. They will register an unincorporated partnership in their stock market.
Who's asking you to register, bhai? Nobody is
Okay.
asking
Mhm.
asking those people to register. All this clause is saying, you know, the concept of deemed.
Hmm.
Deemed means as if.
Okay.
Considered means as if, not actually.
Okay.
You get my point?
Okay.
It will be considered, it will be deemed as if it is an entity under the definition of qualifying investment fund. It will not be actually an entity, or it will
Hmm.
not be an actually qualifying investment fund. It will be deemed as if it is a qualifying investment fund. Does this make sense?
Yeah, but the sir, one last question. Sorry to ask.
No, please
But
carry on.
sir, but if I am the investor, then I will never invest in an unincorporated partnership which is carrying a qualifying investment fund activity. So what do you think from this aspect as well?
Uh, See, to this point, I am going to say that do some more research out there in the world as to what is happening actually.
Okay.
Too many fraudsters are there. Too
Mm-hmm.
many people are there, manipulative people who want to take money from uh, investors, and they're like really, really dashing as well. They say
Mm-hmm.
things that blow your mind, and they even show you things that blow your mind.
Mm-hmm.
And that's how the sophisticated fraud happens and scams happen, right?
Mm-hmm.
So so many of the scammers might want to do, they would play around in the law. But and as practitioners, we have to know about this and imagine those scenarios where it can happen. Anyways, guys, it's already way past time. Thank you very much for today. If there are more questions that you come up with or anything, WhatsApp, WhatsApp on the group, and I will be happy to answer. Okay?
Okay, sir. Thank you.
Okay, thank you very much. Thanks. Bye bye.
Mhm.